Hello and welcome to FML Fund My Life, a podcast brought to you by MyWallSt. We've something very exciting to announce. It's your last chance to grab tickets for tonight's first ever Stock Club live event. This is going to be a great night in which Emmett, Rory, Anne-Marie and Mike are going to be looking back on what has been a brutal year for the stock market, as well as looking ahead to 2023 with some bold and predictably foolish predictions. So, if you'd like to come, it's taking place in Herbert Park Hotel in Ballsbridge in Dublin tonight. Tickets are extremely limited now as it's just hours away with just a few left, and they're available through the link in the description at a price of €20 each, which also includes a couple of free drinks at the bar. So, Anne-Marie, are you excited for the event tonight?
Yeah, I think it should be good. We did a live event for Horizon members last month, 2 months ago. And it was actually, I think everyone kind of really liked it because it gave everyone an opportunity to meet other investors. I think sometimes people get a bit nervous when they're going out on their own and, you know, they see Emmett kind of through the screen and all, but there was something very comforting about having like a bunch of other investors in the room and everyone was going, yeah, this year was terrible, wasn't it? You know, there was just kind of a nice camaraderie in that, and I think people really enjoyed it. And I think it will be good. I think it's always good to end of year shows are always fun because we get to hear Emmett's absolutely outlandish prediction for the following year, followed by a much more moderate and measured and considerate pick. But it's it's always fun.
Looking forward to it. I guess might give us a few ideas for FML in the future for events. So we're going to get back to FML now and what the title of this episode is. It's called Investor Chat, where we're going to be answering some general questions, but also touch on some important topics because of how the market is doing right now. So stick around to hear our thoughts on what is happening right now in the stock market, why now is the best time for young people to start investing, building generational wealth, and why women need to be represented in the finance world to promote inclusivity. So, as I said, the stock market is doing bad right now. The S&P 500 is down majorly at the time of recording. So can you tell us a little bit about what is happening, Anne-Marie?
Yeah, I think like some of it is pretty normal. We're kind of going through a bit of a correction because we had a really sharp increase during the pandemic. We've discussed this before, but when people were kind of sitting around at home, without anything to do, and were continuing to make their regular income, you know, if they were fortunate enough to not be laid off, it meant that people were looking for places to put money, and that put a lot of money into the stock market, a lot of money into like speculative companies, into like high growth stocks, which is what we're interested in, but it also meant that these stocks were pushed really, really high. So some of this is completely normal and admittedly like something that we would like to see because it can be really difficult sometimes to distinguish signal from the noise when everybody is really excited and pouring into the market because it just, I don't know, when there's so much hype and excitement, it's sometimes really difficult to get back to fundamentals and focus on what you should be when it comes to investing. But also kind of beyond that, there's a challenging macroeconomic environment right now. You know, people are frightened of a recession. We're seeing layoffs in tech. And so it is common that in environments like this, you know, people want more cash. It's just kind of a good idea. You know, sometimes people are going, oh, maybe I don't have enough money in savings. And so they are pulling their money out of the market. And so that obviously is going to punish stock prices. And I'd say that we'll probably continue to see that trend for a while. I saw an interesting stat the other day that savings accounts have taken a pretty good hit the last 6 months in the United States, and credit card debt is at an all-time high. So I would say we might continue to see a little bit of money continuing to cycle out of the market. I would also say that when it comes to kind of the stocks that we like to talk about, as I mentioned previously, growth stocks, they've been hit because the people who are leaving money in the market tend to be moving it into kind of more conservative things. So we're seeing people move money into commodities, which would be things like gold and silver. Oil has seen a significant rise during the year. And then like some old world stocks have held pretty firm this year, which I think is just from people kind of doubling down on them. So that's things like tried and tested brands like Coca-Cola or Home Depot, basically like anything that doesn't have any kind of tech exposure. And then traditional brick and mortar retailers, which, you know, are probably specializing in like food, you know, bare essentials, things that people are going to need regardless of what the economy is doing. That's another factor. And I suppose it is worth mentioning, you know, when we talk about the S&P 500, I think sometimes people think like, oh, that's the entirety of the market. You know, if we say, oh, the S&P is down 15%, people are going, well, man, everything must be down. But it is kind of just worth mentioning as a clarity point that when it comes to the S&P, a disproportionate amount of it is made up by the 5 biggest tech companies, which is Apple, Amazon, Microsoft, Meta, and Google. They make up like 20% of the index, which is crazy. Like that's a huge amount, which means they have a pretty significant amount of influence on the overall market. Well, not the overall market, this index in particular, the S&P 500. And 3 of those 5, Meta, Google, and Amazon have kind of been struggling the last couple of months, if not a year. Obviously, Google and Meta have been absolutely hammered by changes in advertising rules, and then Amazon is being impacted by consumers becoming a bit more cost conscious. They're maybe not spending as much, which impacts them. But I guess like it's a good metaphor for the market overall, because Apple and Microsoft have done pretty stable this year. They're sitting kind of flat year over year. So it's a reminder about, I suppose, the importance of diversity. But I don't think people need to be running for the hills and calling time on investing anytime soon. So that's good.
Yeah. So on to more positive things. Why do young people need to invest at all?
Yeah, I mean, I suppose it's a good time to kind of check back in with this. I would say that, if people are scared, maybe they're going to lose their job. If people, are seeing the market fall, it's definitely, if you're like in the first 5 years of investing, I would say you're probably pretty scared. And so it can be a good time to maybe go back and check in with the basics and be like, why are we doing this in the first place? And so I would say number one, and probably I think it's on everybody's mind right now, is like just the rate of inflation. Like inflation is really bad this year, but inflation is something that's ticking away all the time. We don't talk about it as much when it's only 2 or 3%. It's kind of just in the back of our minds. It's not really something that we consider. But, just like compound interest, inflation, as it gradually increases over time, like really does take a bite out of your savings. So, if you're thinking about any kind of long-term goal, your mortgage down payment or your retirement, like it is worth considering how much you're going to lose simply based upon inflation. So, that's kind of, I suppose, step one for investing. If you can invest and beat inflation, you're doing pretty well. That's pretty challenging this year with inflation so high, but it's certainly a worthy goal. And then probably when it comes to young people, it's that the idea of time. Like if you're in your 20s, you have so much time. If you're planning for a long-term goal, like retirement is a ways away. It could be 40 years away. And truthfully, like every investor you talk to, like anyone, like from a professional investor to a novice investor to people who are, just relying upon maybe a financial planner, someone who invests passively, the number one thing all of those people are going to say is that like time is the most valuable thing when it comes to investing. So if you're a young person, you've got lots of that on your side, and you should definitely take that into consideration. And maybe just like one for right now, like maybe why should you continue to invest right now, or why should maybe you start investing or consider investing right now, is that a lot of companies are on sale. Like companies that we absolutely love at MyWallSt are companies that Emmett loves and Horizon. Like they have sometimes had huge haircuts, like 60 or 70%. And, while that can be really shocking to investors, it does sometimes give us an opportunity to go back into these companies that we've pitched and recheck in and say, right, okay, when things get difficult, is this company still well positioned? Is our thesis still hold firm? Do we still love this management team? And that actually does mean that it's a really great time to kind of separate the cream, if you will. Really great businesses are going to stand out in an environment like this in their ability to be measured and conservative and thoughtful. And so we've definitely begun to see that already so far in the last couple of quarters. And so it's almost like, if you were kind of on the fence and considering investing, maybe check back in with some of those companies on your watch list, because you might feel more and more comfortable with them going, hey, they've gone through 3 or 4 quarters of pretty difficult conditions and they're still looking okay, or I still love their management team, or I still think this long-term trend is going to pull through and they're going to be the company to benefit. So, I think it would be a nice time maybe to start an initial position in something you've maybe been watching out for, or watching for a period of time. And then like maybe finally it's just like, why should you invest as an individual? Like why should you create your own short list? Like why should you pick out your own companies? It really is the idea of like typical pensions in Ireland and the UK, like even in the United States, where you'd be more looking at like an old school managed fund through your IRA. You tend to not get like the same returns as you would kind of doing things yourself. And so I think if you're shy at the minute, if you're going, well, why would I, want to seek out an ETF, or why would I want to seek out individual stocks? It's worth remembering S&P 500 does pretty well, and sometimes you cannot access the returns of an S&P 500 through a traditional pension. So it's worthwhile kind of going it out on your own. So yeah,
definitely, yeah. So we've kind of discussed why you should invest, and like why you should invest right now. But can you kind of explain? A popular phrase that's being thrown around right now is that this is the time to, you know, build generational wealth. I've heard like Emmett say and a few other experienced investors. But what do you think that means? Like, to you, what is generational wealth?
Yeah. In my view, like, generational wealth is that which you can, like, comfortably pass down to your children and grandchildren. And I'd say for most people working a standard job, like, we most definitely do not generate enough money, and which, like, we could pass down money for 2 generations. You know, that's a hard ask, because, like, we have to live until we're 80, and then, you know, think of all the things, you got to buy a house, like, you got expenses, you know? And so that really is kind of only something that you can get by investing and by, you know, using compounding and investing responsibly and in a diversified way. Just to kind of reiterate, I would say, like, the only way for normal people like us working normal jobs to get to the point where you have enough capital to pass it down for 2 generations is through, you know, compounding, is through the market, is through investing, is through, you know, responsible investing. let's say that. And I think, you know, if we take it back to 2008, you know, that was kind of the great last recession that we all really remember. And it was very horrible for investors, you know, people who were already invested, and people did suffer. But in the wake of 2008, people who are fortunate enough to have a little bit of capital, they began investing. And between 2008 and now, the number of millionaires in the world increased by 50%. And a lot of those were built on the backs of people who just invested and held on. And, you know, used 2008 as an opportunity to go, okay, what companies are going to be here in 20 years? You know, what companies are going to ride this wave? And so, yeah, I think it's very interesting. I would also say that, like, the dot-com bubble in the 90s, early 2000s is very similar. I'd say we're definitely seeing echoes of that at the minute with all the crypto exchanges blowing up. You know, it's that idea of, we all got really excited about this speculative tech and we poured all this money into it, and now we're going, wow, we really didn't understand this or that element of it, and now we're kind of paying the price. But yeah, I definitely think in terms of crypto, it's gonna show us what businesses are worthwhile and which ones are gonna survive. And so, yeah, when Emmett says like, this is the opportunity to build generational wealth, it's because everything is down. Like, take advantage. It's, you know, it's time to pick out a few companies you love and go for it.
Yeah, I think it basically means, like, now is the opportunity, and this, like, opportunity might not come around in your lifetime because things are so far down. Basically, that's how I interpret it anyway. Yeah. Okay, so then moving on to kind of a flashback, early FML days when we interviewed Jana Haynes from ARK Invest. We asked her a question that I think would be cool for us to answer and discuss. Moving kind of slightly on from the market, but onto women investors. Do you think women need to be represented in finance and investing for more of us to get involved in the world of finance and investing?
Yeah, I think to the first point, I think there needs to be more women in the professional space to get more, just to, like, normalize maybe everyday women thinking about finance in their lives. It certainly makes it easier. I think finance has a really horrible reputation professionally in the view of women. Like, I think a lot of people view it as, like, quite an abusive sector in which to work, and so I think that's kind of put people off, like, having to interact with those businesses at all, which is unfortunate because, you know, as we've discussed in terms of the wealth gap, it's very important to kind of really sit in the driver's seat when it comes to your financial future. You know, do your own research and do your own kind of financial planning. But also, there's, like, a secondary point to this that we maybe didn't discuss as much at the time, which is that when we have more women in the professional financial sector, when we have more analysts who are women, it genuinely improves our analysis and opens teams' eyes to potential investments. We saw that significantly, like, back in the day with Lululemon. Like, Lululemon, I think, was a bit of an ignored company when it initially came onto public markets. I think people thought it was a bit ridiculous. You know, it was quite common to kind of disregard a brand that was focused on women. I don't know. It's just, like, because if, like, their products aren't targeted at you, like, it would be very easy for you to, like, I don't understand this company, whatever, I'm not going to look at them. Like, I understand that, I guess. But, yeah, it meant that it was a really great company that people, like, weren't that interested in until it really began to perform financially. And I think that's a bit of a shame. You know, you could have missed out on some great returns. But I also think I have a good, not a good story, but like, one that's a good reflection on this, which is a while ago I did an analysis on Build-A-Bear, which became a first look in the app, and then we discussed it over on Stock Club. And when I did my initial research and everything, and I kind of had my opinion written down, I typically go and I have a look at just like the top couple of analysts or the last couple of analysts to write about it on Seeking Alpha, which is a tool that we use, because I just kind of want to gauge here, like, is there maybe a point of analysis that I've missed, or like what's something that someone else is considering or whatever. And so I went on, and the first report that I clicked on, discussing Build-A-Bear, the guy's first point, like the way that these analysts write reports is they usually have like 3 or 4 central bullet points, right up the top. And I usually just read those. Yeah. And his number one bullet point right out the gate was Build-A-Bear has a strong, like, long-term tailwind because of the overturn of Roe versus Wade in the United States will mean that more people will have children.
Oh, yeah.
And
that was such an ignorant statement.
Like, I could not believe that this man had written that down in a formal analysis of a company. Because not only is it statistically incorrect, like making abortion illegal does not reduce abortions in any sense of the way, but like...
That's true, yeah.
So detached from reality that you think, oh, if people are forced to have children, the first place they're going to bring them is Build-A-Bear Workshop. Like, I just could not believe that like his brain had led him to think that that was an acceptable thing to write down, or even that it was like an actual tailwind in any sense of the word. And like, all I did was when I read that, I was like, if he had run this by any woman, she would have been like, oh, bro, like, you should take that out. They'd be like, no, that I don't think that's a tailwind. Like, you should maybe go back and do a bit more research on that or reevaluate that. And so I was like, this is a shame, because like, if he had like a female colleague or a female friend, and he could be like, hey, like, what do you think of this? It would have been fixed, and that would have been the end of it. And so it just reminded me, I was like, Jesus, we might need to get a few more women writing these analysis reports.
Yeah, and like, even if it was statistically true and backed up with research, it was such a sensitive time, to say something like that, because that decision, obviously was affecting so many women, upsetting so many women, like, it was human rights violation, basically. So it was just a crazy thing to put in, like, this is why you should buy this stock. Like, it's just so like, we don't really care about anyone's feelings. It's all about making money. Like that. I remember when you told me that, I was like, even if it was true, it should not have been, put in like that. It was, as you said, a woman would have like definitely checked him on that.
Yeah, and then it wouldn't have gotten published, and then like I wouldn't have had to see it with my eyes and been like, well, like, it just I was so frustrated. But to credit the Seeking Alpha commentators, there were a fair few people down in the comments of the article being like, I don't think that's appropriate, like, that's not a serious tailwind. You need to do more analysis here, blah, blah, blah. So to be fair, like, the community did kind of come together to be like, listen, man, you can't say this. But I was just shocked that it never got written down in a formal report.
Yeah. But back to the question of kind of like women investing and being put off if the market is doing really bad now. Like, I think that was one of the aims of this podcast, is to, help women not only to be represented in finance and investing, but also, like, I just think representation is so important, because when I think of what podcasts I listen to, they're all like women led. They are. That's just because that's who I relate to. So when I think of like My Therapist Ghosted Me, the Sinead Says podcast, there is a reason why we gravitate to people that are, like us. And they're all Irish actually as well. But I definitely think that because of the big gap in representation, it's no shock then that like there's less women investors, for sure.
Yeah, I also think like something we discussed when we launched it was just kind of creating a place for people to ask questions where they maybe didn't feel so intimidated. Where you had an Instagram or a Twitter to send a DM to be like, hey, like, maybe this is silly, but like, how do I set up a brokerage account? Like, totally cool. Send all of those in.
Well, that's a great lead in to our next section, because it's listener questions. So I put up an Instagram question yesterday on our Instagram page. If you don't follow us, it's at My Life podcast. So the first one came in from Carl McManus, and he asked, do we think that Disney has much growth left as an investment opportunity?
Yeah, this is a pretty great question, pretty apt question at the minute, because they just had a CEO turnover. That was like a shock, very shocking. It's very clear to me that Disney's board met in secret over the weekend and voted out their CEO, which is quite a radical move to see from kind of an old world company. But just to kind of dig in on Disney as an investment, so Disney basically makes money in two ways, which is the entertainment, which is the kind of entertainment side of things, which is like TV, movies, streaming. You know, when you think of like Disney as a content house. And then the other side of things is parks, experiences, and products. You know, Disney World, Disneyland, Disney Cruises, absolute nightmare. And then think of all the merchandise they sell. So like those are the two sides of the coin. In terms of profitability, right? So profit, not revenue. They make way more money off the parks and experiences, like just raking in cash. Very, very impressive margins over on that side of things. Yeah, I think the cruise ships generate a huge amount of money. So that's kind of where the profit
I'd say the insurance, though. The insurance on the parks and the cruises must be massive.
Yeah, but I heard in the last year to 2 years that the cost for Disneyland and Disney World has gone up substantially. Like they increased ticket prices quite a lot, which we're actually going to talk about in a second here. So, so that's kind of how they break down. And like the issue is that probably for the next year or two, both segments might struggle. What I mean by that is while the parks are back to pre-pandemic levels in terms of revenue and profitability, they are in kind of a much worse macroeconomic environment than we would have seen in 2019, because the main way that they generate revenue growth or profit growth out of the parks is by having incredible pricing power. You know, like there's only one Disneyland, there's only one, Disney World. Well, there are multiple, but you know what I mean? Like there's only one company that can make that experience, and that's Disney. And that means that, if they want to raise ticket prices by 10%, they're going to do that because they most definitely have conducted research that proves that consumers will continue to spend the money. And so that tends to be where they generate growth from, is being in that comfortable position. But as we know, and as we've just discussed over the last episode, we seem to be heading into a recession. And so the likelihood of Disney being able to bump up ticket prices or the cost of food or the cost of accommodation by a couple percentage points, the likelihood of that being able to happen is lower. And so that might mean that, growth in that segment might go on pause for the next year or two. So that's the unfortunate part there. And then on the entertainment side of things, they're kind of struggling twofold. So they're kind of stuck between a rock and a hard place in the sense that traditional TV revenue, so like ads on their, Disney Channel or whatever, is that's suffering because ad revenue kind of across the board is down. But particularly we're beginning to see ad revenue rotate out of traditional TV and head towards, streaming or head back towards social media or something like that. And so that's difficult. You never want to see an old reliable revenue stream begin to dry up. But then on top of that, streaming spending over at Disney is just out of control. Like they poured an awful lot of money into building up Disney Plus, which I fully understand because, if you're building up a new product, a new revenue stream, like that obviously costs money up front. You got to build the platform, you have to produce the content for it. Like that, I suppose that's fair enough. The hard part is now we're in this difficult macroeconomic climate, and that huge rush of spending becomes really difficult to justify to stockholders. And then you're stuck in this position of constantly having to be like, yes, we're burning through all this money, but don't worry, it's going to pay off in 2 years, or it's going to pay off in 3 years. And so in Q3, which Disney just finished last week, their streaming service operating loss rose by $800 million to $1.5 billion, largely because of rocketing content spending and marketing expenses. As a result, operating income at Disney's Media and Entertainment Group plunged 91% to $83 million in the quarter. So as we can see here, they have an awful lot of money going into Disney Plus, which again, I understand, like you have to produce this type of high quality content. I would assume here that they might be overspending a bit. I know that they love spectacle. Like I know they love doing the Marvel and the Star Wars TV shows. Those can be really expensive to produce. And so I would maybe like to see them producing some stuff that's a bit cheaper. They have already discussed the fact that they will be cutting spending to Disney Plus. I just hope that it means that, they're spending less on each project rather than cutting projects altogether. I think continuing to produce consistent content is really important on the streaming side of things. And it also kind of impacted our ability to feel comfortable in Disney Plus generating profit. So, Netflix has always been kind of the strong one here because it's had a huge jump start on streaming. It's what 8 or 10 years ahead of its competition, which means it's at scale now. It knows how to, generate a profit off of all of its subscribers. Disney has said, we anticipate Disney Plus to generate profit in 2024. However, on their latest call, their now ex-CEO, Bob Chapek, he actually said that we will become profitable in 2024 based upon if consumer behavior remains positive. So basically Disney said, listen, if things go according to plan, we should be fine. But they basically said what a lot of businesses are saying right now, which is we don't know if the plan is going to work because we're in a really unpredictable environment. So that has hurt Disney significantly. And then, they've just had this massive CEO changeover, which I discussed at the top of the segment. So Bob Chapek has been kicked out. He only took the position in 2020. He was kind of heralded as the champion of Disney Plus. He's gone. And we had Bob Iger come back, and he retired in 2020. Bob Iger was really important for heralding in like Marvel and Star Wars into the Disney fold. He was responsible for helping to kind of double down on the parks and stuff like that. And so it'll be interesting to see what Iger does. I would expect him to cut spending when it comes to streaming, but then you have to weigh up, is this going to significantly weaken our streaming service, which is about to launch ads, I think, at the beginning of next month. So I understand like this question. It's difficult to count out Disney as an investment overall because they own so much IP. Like, think of all the famous movies and TV shows that Disney has produced. They continue to own all of that stuff, and that stuff is worth money. They can generate new content out of it or sell new products or whatever. But when it comes to growth, which is what this listener was asking about, like for maybe the next year and a half, upwards of 2 years, I could see Disney having a hard time growing. And it's because of this macroeconomic environment and also just the kind of difficult position they find themselves in, where they're juggling this new product, their old product is falling out of favor, and then also their kind of star of the show, the parks, can't really demand more money from their experience until everyday people are a bit more firm in their economic standing. So a bit of a difficult time over at Disney, but I think it's not all doom and gloom. It's just they're in a tough spot, and we'll see how they figure it out.
Okay, great. Thanks for that, Anne-Marie. That was a really in-depth answer for Carl. Hope you enjoyed. So quickly, we're going to give you a quick girl boss of the week, because I think this podcast might be under 30 minutes for the first time ever. So Anne-Marie, who is the girl boss of the week this week?
Girl boss of the week.
This is a very quick one. There's not much analysis here at all, which it's just like a callback
Perfect.
to, do you remember the NFT episode that we filmed? We did 2 NFT episodes. I think this was in the first one. As we all know, I have a vendetta against celebrities that keep plugging all these digital assets, because I think it should be illegal and it should face some sort of regulatory scrutiny. But one of the main stories I talked about was the fact that Justin Bieber went on The Tonight Show, and he talked about how he had bought a Bored Ape, and Jimmy Fallon from The Tonight Show had also bought a Bored Ape, all these celebrities buying up Bored Apes. And at the time, Justin Bieber paid $1.3 million for his Bored Ape, and this week it is now valued at $69,000. So that's quite a haircut.
Oh my God.
That's a significant fall.
Over 1 Jesus.
Yeah.
Well, you know what all I have to say for that is Team Selena. That's all I have to say.
Shall we release
perfect.
an NFTs
Thanks, Anne-Marie.
next week? No problem.
Exactly. And we'll be buying them all. Okay, so that's a wrap. Thanks so much for listening.
If you enjoyed this episode, tune back in 2 weeks' time.
And if you want to follow us on socials, please do. You can find us on Instagram at Fun My Life Podcast, on Twitter at MyWallSt HQ, and on TikTok at MyWallSt, and on our new account dedicated to the podcast at Anne-Marie and Nicole FML, which isn't that new anymore.
There you go. And finally, if you are ready to start your investing journey and are looking for resources, check out MyWallSt's Getting Started podcast anywhere you listen to podcasts, or download the MyWallSt Learn app. Both will be linked below. If you would like to keep up to date with all the exciting things happening at MyWallSt, make sure to subscribe to our free newsletter. The link to do so is in the description of this episode.
Perfect. That's all from us. We hope you enjoyed listening.